Market turmoil. Hey everyone, it's Wolfgang. So this week, November 10th through the 14th, the market sort of reversed recent gains. Let's take a look at that. Let's take a look at what went into the market sell-off this week. So it lasted nearly the entire week, November 10th through the 14th. What triggered the sell-off? Was at the end of the shutdown. The shutdown ended, buy the rumor, sell the news, is an old saying on Wall Street. So the end of the shutdown occurred. Did people sell stocks to lock in gains because it was big news? I mean, that was big news. The government shutdown affects not just the United States. It sort of has ripple effects to the entire planet because the U.S. is the largest economy on the planet. So was the end of the shutdown? Is there a Bureau of Labor Statistics job news that's imminent, that's about the economy that people are waiting on, maybe have some expectations about? In any event, the market did sell off. The volatility index, the VIX, was over 23 on Friday morning around market open. The VIX was a little bit higher than normal. Anything over 20 on the VIX, the volatility index, is a sign that the market is volatile. So that means highs and lows are become normal, right? Ups and downs. And it has not been this high. The VIX has not been this high since October 16th. So we had a great run in the markets last week. This past week kind of sold off. So here's a question. Okay, we're trying to figure out, why did the market sell off? Is it the large debt loads taken on by the big tech firms? Some tech firms have saddled themselves with debt. Oracle is one. Meta is another one. These companies are taking on a lot of debt to buy and build out AI infrastructure, data centers. So they're taking on debt for artificial intelligence. The stock market has been trending up in a narrow range of big tech companies, and all of a sudden these big tech companies are taking on debt. So are people kind of freaked out about that? Is it a mixture of these reasons? Probably, right? So there are some of these big tech companies that have avoided this inclination to take on a lot of debt. Amazon has not taken on tons of debt, new debt for AI. Neither has Google, neither has Microsoft. Now, they have ongoing AI projects, but they're not like Oracle and Meta. Oracle and Meta are sort of, bet the company levels of debt load. So you can compare this to a personal situation. If you were a person taking on a lot of debt in your personal life, it would put you in a position of being a little bit on edge, making sure you can make the payments on everything. These companies are not really facing that. For example, Microsoft's debt to equity is 30%, Google's is only 10%. If you check these guys, Oracle and Meta, they've taken on huge debt. People are noticing that. Oracle stock has sold off. The new bonds Oracle has issued have dropped in value. People are applying scrutiny to these big companies. Microsoft, Google so far, Amazon, Apple to a lesser degree. Apple is buying AI, but they're not building artificial intelligence infrastructure or data centers. They're buying it or leasing it, right? So this is a point that a lot of people are probably not super familiar with because the market's been going up pretty well this year. But generally, there's a market sell-off of 10% or more on average once per year. Okay, once per year, the market tends to sell off 10%. This year, this happened in April. If you look at the history of the markets, in April, we had sort of a big drop-off. And the market has trended up since April. But generally, each year, there's a drop of 10% or more, right? So we've had a drop in April. We're not down 10% in stocks, at least not as of this week. We've had a sell-off, but not a huge drop again, not like April. Okay, but for 2 weeks in a row, the Standard & Poor's 500 index, which, by the way, if you wanted to buy or have exposure to the S&P 500 index, you could invest in the SPY, Exchange Traded Fund. That's a pretty diversified portfolio. But for 2 weeks in a row, the S&P 500 has fallen. That's pretty rare. The reasons cited include scrutiny of being applied to tech stocks, the huge hyperscalers, the companies investing in AI, scrutiny being applied to them, and also the economy is a bit slow. But in general, there's sort of this risk-off caution by investors, a risk-off situation. This entire week, people were taking profits. We're not quite at the end of the year. There's still quite a ways to go. I mean, if we were in December, slightly different story, but this is only mid-November. We have a month and a half to go before the end of the year. It's sort of too early to be selling winners. A lot can happen in the market. And I would say the artificial intelligence uptrend, it's only at the very beginning. ChatGPT, which was the catalyst, has only been around for about 36 months. 36 months of a new look at artificial intelligence, user-friendly artificial intelligence. It's too early for a crash. If you want to compare it to the dot-com bubble burst, the catalyst for that was the Netscape browser, which was the user-friendly interface to the existing internet. That came out in the mid-90s, 1994. A crash did not occur for 7 years. So we're way too early to have a huge crash in the economy or in stocks because people have made a mistake on artificial intelligence. It's just too early. So I think we have a ways to go. So there are a couple things that could not fit on the board. What are the effects of the sell-off on crypto, and what's going on with the bond market? Okay, let's take a look at that. So crypto has definitely sold off. If you look at the notes, the low on well, actually, this was not even the low. Bitcoin dropped below 95,000. Bitcoin on Friday dropped into the 94,000 range. It hasn't been that low in a long time. Ethereum dropped quite a bit. U.S. dollar tether, they tried to keep as close to the dollar as possible. It held up pretty well. Bitcoin and Ethereum really showed, compared to gold, if you look at the price of gold, the gold held up pretty well, but crypto did not do so well, so they experienced the sell-off also. Okay, what about bonds? Because when people get skittish about equity investing, stocks, they will buy bonds. Okay, so most of you know this, right? When people are buying bonds, the price of the bond goes up. Anything that's in great demand, the price will tend to go up. With bonds, when the price goes up, the rate of return, the yield, goes the opposite direction, drops. Okay, so the past week was a sell-off. You might have a question, okay, if people were selling stocks, were they buying bonds, pushing the price up and the yield down? Let's take a look at the 10-year. The 10-year is at 4.1%. Okay, the U.S. Treasury 10-year bond, by the way, U.S. bonds, U.S. Treasury bonds are a safe haven, kind of worldwide. Everyone on the planet knows if you want a safe haven for money with a slight return, U.S. Treasuries are a good choice, right? So right now, the U.S. Treasury 10-year, which is connected to the mortgage market, mortgage rates, home loans, are driven by the 10-year bond. Right now, the 10-year is at 4.1%. So let's compare that to the last 2.5 months, because we're midway through November, right? Let's look at all of September, October, and midway through November. At the beginning of September, they were only the 10-year bond was only at 4.2%. So the 10-year bond has not dropped in yield very much at all. Okay, so if people were really running for the exits and buying bonds because they're really scared of a crash, we would expect to see the 10-year drop more than that, and it really hasn't dropped. In fact, it's gone up from the lows that it had. If you look at the 10-year, it was down below, it was down 4.0 something, right? Now it's up to 4.1%. So people are not really panicking. They may be selling artificial intelligence stocks because they think those are cash generators. Those are the winners. There does not appear to be a panic in the market. So I would exercise caution if you're in a frame of mind, if you find yourself listening to bad news. Keep in mind, bonds have not really dropped hugely in their yields. The sign of a panic would be when so many people are buying U.S. bonds, the yield just drops. I mean, the price goes up, the bond price goes up, and the yield just starts tanking. You would expect to see that, right? That has not happened. So keep that in mind. So there's two takeaways from the sell-off. Yes, people have been selling probably to raise cash because the AI stocks have gone up quite a bit, and there are other reasons why AI stocks have been sold. But the two things to keep in mind: if people were running for the exits, bonds would be bought, right? And artificial intelligence is too early in its lifespan, the user-friendly AI, for there to be a huge sell-off. So I would keep those in the back of your mind if you're thinking about, I'm getting completely out of equities, I'm buying, I'm taking the cash and I'm parking it somewhere. Where are people parking it? They're not parking it in bonds because bonds are not tanking. So this might be a place to look, would be U.S. Treasury bond yields. If you start seeing those drop and the price of bonds going up significantly, more than they have now, then maybe you start to wonder. But right now, we're too early in the artificial intelligence build out for there to be a huge crash. So don't look for that. I think some people who have sold expecting the worst of the worst, I think that's probably a mistake. We'll see, right? I could be wrong. If you have any questions about this, I'd be more than happy to answer any questions you have. Please post in the comments. And I really want to thank everyone for watching. Have a great day.